Next Friday's Federal Reserve meeting is to decide on the interest rates once again, scheduled for October 28th through 29th, 2025. While the Fed's decision isn't guaranteed, market analysts are widely expecting a quarter percentage point rate cut. And to give you an idea of how wide we're talking about, the probabilities of getting to a 3.75 to 4% rate or a 25 basis point cut are 99.4% of easing probability according to Chicago Mercantile Exchange, and a 0.6 probability of holding rates still.
Okay, so that's pretty much their way of saying book it.
Regional bank stocks are sliding again, showing that the market is waking up to the underlying fragility in their balance sheets. These are not separate stories. I know they sound like that. That's the whole point of this show. They are symptoms of some disease, the illusion of stability being ignored when the cracks are coming up around you. And there's still stuff in the CRE office space that is concerning, right? Mm-hmm. Office has never recovered post-pandemic.
These are the ones that change this. That's why you kept modifying it?
Well, no, I kept asking off, and he kept giving me like ideas. And then I thought, like, all the great YouTubers, like all the guys that are like, notable on YouTube, like the Mr. Beast, they always talk about how they change YouTube covers and they micromanage details. And I was like, all right.
I've seen them in real time update them after releasing it an hour later.
I've done that too. And now you can A/B test, which is interesting on the YouTube thumbnails, which I'm still trying to figure out. But if it works, it works, baby.
You live?
Yeah, we're live.
Welcome back to the #1 financial literacy podcast in the world. This is The Higher Standard. Wouldn't be The Higher Standard without a can pop. Sitting in front of me is my partner in crime, Christopher Nahibi.
Sitting across from me, my partner in time, the one, the only, the man, the myth, the guy who wears black shorts with sexy knees who you never get to see.
You don't get to see it. You don't know if it's true. You don't know if he's lying.
Saied, everybody.
Thank you, my man. And sitting behind the desk in the production suite is nobody.
Nobody.
No.
Hey,
camera cuts to nobody. And we're back.
Yeah.
Today's podcast, episode 306.
Yeah.
Man, we're in the 300s.
Behind our back, I was thinking about doing something.
Behind? Oh, really?
Because I feel like, not just behind yours, but, I last episode, the one that's dropping tomorrow for us, for the listener last week, 305. I was going to call the Miami edition and do like a 1980s vibe, like Miami Vice thing.
Miami Vice, there you go.
And then I thought, I'm not that creative.
What's the Miami Vice? Okay, what was the main guy's name? Dean Johnson? No. What's his name?
Don Johnson.
Don Johnson. One of my father-in-law's clients back in the day would buy all his suits from him.
Okay.
Yeah. Also hard.
I'm not sure how that story's relevant.
No, you said Miami Vice. Come on. What are you talking about? Today's episode, and headlines are saying inflation is cooling. Fed saying that they're ready to ease, probably because of insecurity in the job market.
Yeah.
But we're seeing a lot of signals of fear in the market.
Yeah. And I think that one of the conversations that I've been having repeatedly with people has been, Chris, look, the market's at an all-time high. People are investing in gold, and all these good things are happening around us. How can you feel so unsure of the market?
Mm-hmm. And on top of that, Fed's signaling, everyone's saying that we're going to have more rate cuts. What do rate cuts normally do for growth stocks like in tech that's been literally carrying the S&P 500? They're probably going to continue to rise for the short term.
Yeah, their borrowing costs go down. Treasuries start to normalize. Businesses start to make more money. As businesses make more money, they trade at higher multiples and so on and so forth. And it ends up becoming this cascading benefit to society. Well, what I would tell people is there are some warning signs that are flashing very much red right now. Warning signs that should not be ignored, but are oddly being spoken about in circumstances which don't necessarily align with fears of recession. And I get it. Lots of people on social media, on the traditional media, all talking about, oh my God, let's use fear as a way to get people to listen to our stories. That's not what this is.
Okay, I was going to say, do you think that's what it is? Or is it people and networks trying to cover their bases and in case things do go south, they can revert back and be like, look, we've been talking about this.
So let's play this out. I want to deliver on the promise. I want to talk a little bit about the FOMC meeting coming up because the probabilities are wild here.
End of the month, yep.
Yeah. I want to talk about the regional banking crisis. For those of you who've probably heard, Zion's Bank has had some issues. I want to break that down from experienced bankers' perspective.
Bang, bang.
And then I want to use that to get into some other parts. There's some card defaults, delinquencies we've all heard little bits and pieces about in the media and on social media, but what does that really mean and what does it really look like?
Yeah.
I want to talk a little bit about the housing market, and then I'm going to use some other proxies for weakness in the economy, most notably the film industry.
Okay.
Been some weaknesses there. And then gold. Gold is a big one that I think people are overlooking because it seems like it's flashing positive tones, but I think there's an underlying negative rhetoric there.
Okay. Yeah, let's do it.
Yeah. So jumping right in, let's go right into the FOMC meeting. Next Friday's Federal Reserve meeting is to decide on the interest rates once again, scheduled for October 28th through 29th, 2025. While the Fed's decision isn't guaranteed, market analysts are widely expecting a 0.25 percentage point rate cut. And to give you an idea of how wide we're talking about, the probabilities of getting to a 3.75 to 4% rate or a 25 basis point cut are 99.4% of easing probability according to the Chicago Mercantile Exchange, and a 0.6 probability of holding rates still.
Okay, so that's pretty much their way of saying book it.
Yeah, that's happening. The only real question is 25 or 50 basis points,
50,
given the rhetoric.
50 seems a little aggressive, given that there hasn't been any major headline risks as of just yet. I mean, there's still time between now and the end of the month. Right?
Well, and then keep in mind, if you're the Fed, now you're playing into a darkness market.
Right.
You're not getting the same breadth of reports that you once got before from the federal government because we're in the middle of a government shutdown for, I think, what's it been, 10 weeks now?
No.
8 weeks? What has it been?
No, it's got to be 4 weeks.
I have no idea.
Yeah,
It felt like an eternity.
Yeah.
How about that?
Yeah.
So
it definitely, and I'm sure for some people that have been furloughed, they're sitting at home not getting paid. It feels like a very long time.
Longest one in history was back in 2018. It was the same executive branch, and because of that, you saw a 35-day holdout period. And the reason why I went 35 days was because, typically speaking, if you're a furloughed worker and you're not getting paid until this whole thing resolves itself, that's when your first paycheck would have really gotten material and could have come through.
There you go.
You're
right.
a full month behind. Right. So I think, and then around that point, people start having trouble paying bills. It becomes a challenge. People start to go apply other jobs, other places, and then you have to replace people.
Right.
The question is, do they want to replace these people? And is this part of a, efficiency to reduce size?
Mm-hmm. But there's really two ways this ultimately, this narrative gets controlled, right? One way is we're starting to get to our target marks, and we can there's optimism, we can start to ease. And I think this is the way that the Fed was hoping people could take this, not the other way where we're entering into a dark market and, the labor market is really starting to see some strains, and we need to make sure we protect this because it can go south really quickly.
That's an interesting thing, too. Everybody that I know that's actively searching in the labor market for a job today is not having a wildly successful time.
I mean, and the numbers are showing it, right? I mean, we saw that. I think job openings are at one point not too long ago there was 2 job postings for every 1 unemployed person, right? Now we're looking at, I think, a little bit over 1, right? 1 job posting, and we know a good chunk of those are you're not getting full-time employment. It's a lot of partial employment, and you're not getting paid the same, right? And a lot of them are also ghost positions.
That's right. So I think there is something to be said for the fact that you got a Fed that's going to be cautiously optimistic about cutting rates and continuing to do so. They've talked about easing the liquidity policy as a part of this conversation. So I think what you're largely going to see is 25 basis point rate cut, no sensationalism. It's going to be pretty much on schedule, what everybody thinks. And that's what you're going to get for this FOMC meeting. Now, leading into this, however, you've seen a regional bank crisis where you're seeing stocks sliding once again. Lots of regional community bank stimulus. And this all started from Zion's Bank. But I wanted to read something. It's a little bit long, so bear with me here.
Okay.
That I read on X. And this was in and around the time that the Zion's Bank situation started to begin. Regional bank stocks are sliding again, showing that the market is waking up to the underlying fragility in their balance sheets. When the 2-year falls this fast, it usually means investors see a shift from inflation risk to credit risk. Remember that. Inflation risk to credit risk.
What does credit risk mean for people out there?
So for inflation risk, you're looking at, okay, things are getting more expensive. Because things are getting more expensive, this could have a dramatic impact to banks' financial position. Credit rate, and I'm watering it down a little bit for purposes that it's not so important because now we're seeing inflation come down. It's not the primary concern. Credit risk is, have there been weak credit practices in the market that will lead to additional defaults? And those defaults will mean that banks will have to cover those losses, which means banks' earnings will be weaker.
Yeah.
A great, massive, and the most obvious example of this, the Great Financial Crisis back in 2007. Lots of people defaulted on their home mortgages.
Yeah, I don't think this time around, if credit risk comes into light, it's not going to be viewed as the same credit risk as back then. It'll be a different kind. Maybe something like you have too high of a concentration in a specific sector or industry, right? Versus your underwriting practices
Well, that's the question right now. You've seen a lot of that in the news right now. Are the banks' underwriting practices? So we know that for single family, Dodd-Frank came in and reformed that entire process. And as a result of this process, what happened? Well, banks got really tight around single family lending. And if you try to get a single family loan in the last 10 years or so, since Dodd-Frank's been out, I think it's been that long, you wind up in a situation where you realize that it's materially different than before Dodd-Frank was passed. It's not just black and white.
You really got to show the ability to repay.
The ability to repay and the ability to repay rule specifically are really meaningful, and banks hold a pretty hard line there. But there's also a private credit market, which we're going to hear a lot about in the future, where people are issuing credit outside of the bank ecosystem, where they're getting cheap funds and they're loaning it out. They don't have any rules. It's the Wild Wild West. We talked about private equity on episode 304.
Yes.
And in that, with AI and private equity, that could inherently be the catalyst for this. That could be their credit defaults, because private equity underwrites their investments the same way a bank underwrites their loans to you.
That's true.
All sorts of different vehicles. Hedge funds, private equity, venture capital, banks, it's all underwriting, baby.
It's true. Yeah.
And you and I have an underwriting background.
Just a little bit.
So we can talk that shit.
A little bit. We can talk that smack.
All right. So the bad news for smaller and mid-sized banks, because they're heavily exposed to commercial real estate. And that is something that we're going to have to carry on a conversation with throughout this dialogue tonight. They carry a lot of the low-yielding assets from zero-rate era and have to fund themselves in a much tighter environment now that emergency facilities like the Fed's BTFP have expired. Now I'll explain that in layman terms.
Yeah, break that down.
Community regional banks hold a majority of commercial real estate, not just multifamily, but office space.
I want to say
industrial.
I think I looked at this today. It was over $2 trillion of commercial real estate debt, which makes up of approximately 80% of all the commercial real estate debt.
And there is a bigger conduit style market, the larger massive loans, think 25, 30 million plus, all the way up to hundreds of millions of dollars, where I think the larger banks will play, or some banks will share participations in these things. But for the most part, a lot of the stuff that you see driving up and down the freeways and the streets, that's just your community regional bank backing a small business. Okay. And if it's owner occupied, that small business's cash flow is used to underwrite that property.
Yep.
Right? If it's not owner occupied and it's an investment property, then they're going to look at how much that property can make. They're going to use something called the debt service coverage ratio. What would this rent for in the open market to anybody who was an occupant for it? And they're going to take out the expenses, and they're going to go from there and come up with a dollar in profit for every dollar in expense, and that ratio is the DSCR, debt service coverage ratio.
There you go.
If you don't understand it, don't worry about it. For the purpose of this conversation, just know that banks hold a lot of this risk. And from the zero interest rate environment, here's the problem for most banks today. Is the last, I used to say 14 years, but it's really now it's closer to 16 years of artificial interest rate deflation. You had rates held at near zero before the Fed started to raise rates, and now are cutting them back down. Banks were making loans on commercial real estate at 3% in some cases, at 3.5% in some cases. And it used to be that multifamily apartment loans carried inherently lower risk than, like, for example, a retail strip building, because if one tenant leaves, it's harder to rent that to one tenant versus if one tenant in a multifamily apartment complex leaves, you have several other tenants. If it's
people need somewhere to live,
diversified risk, right?
Yeah.
So it used to be the spread between the two of them were really high, meaning that you would have like a 1% or maybe 2% spread between the rates you would give somebody on a multifamily commercial real estate loan versus a retail or an industrial commercial real estate loan. Well, during that same period of near interest rates, those rates got really close together.
Wow.
Matter of fact, people were so competitive for pricing that everybody was getting effectively the same pricing, no matter what the underlying relative risk was.
And then what happened when interest rates started to go up and values started to come down?
So now you have a market where you have that cash flow for these properties stays about the same, but their expenses go up. Insurance goes up, taxes goes up. Some of the operational expenses relative to electricity and gas and utilities goes up. R&M, the maintenance on these properties goes up, because guess what? Wood costs more, steel costs more, contractors cost more.
Everything costs more.
Everything costs more. And these properties, for the most part, did not have rental increases that kept up with that level of inflation.
No.
Remember, inflation to you, the consumer, was about 9% according to the headline number, but we know that we really felt closer to 20%. Well, business owners are no different. They really felt it as well. And the mom and pops can't pass that on to the consumer just as easily, because they can't raise their prices fast enough to catch up. So banks now have all these loans where they're going to effectively double the interest rate, and a lot of them cannot be refinanced at the same leverage they were at a couple of years ago.
No, they got to bring cash in.
And therein lies the problem. If you're a small business owner, do you have the money to bring cash in?
Probably
a lot
not.
of them don't.
Probably not.
So what do? You sell the property, you default on the property and try to figure out a solution.
If some of them have, this isn't what it's made to be used for, but if some of them have these lines of credits that they tend to use like in case of emergencies like this. Guess what's probably not getting renewed this time around?
Yeah, the revolving line of credit for businesses space is going to be an interesting narrative over the course of the next couple of years. A lot of these business owners, unless you have an accounts receivable, accounts payable line with agings and stuff like that, and a lot of people don't, they usually prefer ones that I would call are a little bit less structured, then you wind up in a situation that means that you've liberally used that however you see fit or however you need to.
I would really like to go and do maybe in the future, my idea of where we could take this podcast, right, is not only the full-length episodes that we do, but some shorter form content where we show people how you can, I guess, effectively manage a line of credit for a business using that type of model with agings and your accounts receivables and how like a proper business runs it. Because
how the aging process works.
Yeah, because I mean, a properly run business will use that line to scale their company properly. And for a lot of people who maybe have never taken a business course like this or had, a mentor to help teach them, you're leaving money on the table. You could use this to your benefit to help scale your business the right way.
And there's also lots of different types. There's like factoring, for example, which I'm not a big fan of. There's lots of different types of lines of credit that are available to businesses. And if you're a small business owner, like you just think, I need a line of credit that I can just tap into when I need it. You don't think about the infrastructure of what this looks like for you. And most people rely on their community banker to teach them what's the best. Well, the problem is some of these community bankers aren't that talented, and some of them get incentivized to sell you a different product.
Yes.
So you really have to know what you need. And I think where a lot of them figure that out is they go to trade shows, and similarly situated entrepreneurs in the business tell them what they have. And they kind of triangulate what works.
Oh, I'll just do what they did.
Yeah.
Right.
Yeah, Billy got this.
Yeah, but you got to be careful because you might not have the same business model.
That's right. Or, they're not telling you the facts of exactly what's going on with them for competitive reasons. So you never really know. These banks are getting squeezed from both sides. Deposit costs are rising while loan demand is slowing, and the value of the securities portfolio is still underwater. It's true. You bought a ton of securities the last 10 years. Those securities have unrealized losses in them.
That's the scary part. And that's the part that, the three banks that went under, right?
New York Community Bank, First Republic Bank, Silicon Valley Bank.
And Signature Bank, too. So four. They had a lot of unrealized losses, right? And when those started to get reported and people were starting to go in, there's that contagion period that got built out, right?
That's right.
That's really what freaked out the market. And every bank was basically held hostage to headline risk.
And keep that in mind. So we're going to talk a little bit more about how much headline risk and freaking out the market really impacts a bank's balance sheet, because it's actually kind of shocking.
Yeah.
Because you see all these headlines and you go, oh my God, and you see the market reaction. And I'm going to pose the question now for a little bit later on in the show. Is the reaction a rational reaction to the numbers that we heard? And I'll break down the math, and then you, the audience, can decide.
Yeah.
So regulators are going to tighten around the banks, the lending standards, especially around office loans that need to be refinanced in a weaker property environment. Add in the risk of deposit flight, higher yielding money market funds, and you get a recipe for shrinking margins and rising credit concerns. This, when banks just came off of a very economically prosperous, earnings calls week. Okay, J.P. Morgan, Jamie Dimon came out and said there's cockroaches in the system.
I saw that. Interesting choice of words.
Where there's one, there's likely more. So now everybody freaked out about fraud risk.
And you haven't really, with this narrative going around with there being, a lot of regional banks potentially at risk here. I'm not hearing much about these banks are, too big to fail. Like that conversation isn't coming around. It doesn't sound like.
Okay, we'll walk this through. Okay, if you're J.P. Morgan, and you're Jamie Dimon. You want these banks to fail because you're willing to be the white knight, roll in, buy First Republic at a discount.
Get somebody at it. Exactly.
I don't want to do this, guys.
I'll help you guys out.
Yeah, if I have to.
Right. Just get more market share.
I don't want more market share, but if you need me to serve the American people, I'm here for you.
Right. Just tell me how much.
I don't need this. But if you're going to sell it to me at a deep discount.
Yeah, and make sure that offer, you're right, you come correct with that offer, because if you don't come correct, then sorry.
I mean, you can talk to Brian Moynihan over there, but...
We haven't brought up old Brian in so long.
B of A CEO. He hasn't been doing this.
He's flying under the radar, bro.
Yeah, he's been real quiet as of late.
I think he started realizing he was talking about, like, old data.
Oh, no.
He was always talking about one quarter too late.
You fired that guy, right?
I'm like, bro, like, how do we have more updated data than you?
What pissed me off is all the talking heads on CNBC are like, oh, Brian, you know him. He's just a statistical nerd. I'm like, what?
Yeah, exactly. Oh, man.
Moynihan's like, them higher standard boys been coming for me.
Right, he was talking about like his they're a consumer bank and he sees the savings accounts of all
The consumer's in a great position.
Yeah, I'm like, bro, what?
I'm like, what consumers are you looking at, my guy?
Yeah, I don't think we're seeing the same.
Moynihan?
Yeah.
Yeah, no.
Jeez, Brian.
And then everybody on CNBC was just, Brian, statistical nerd.
They just want him because
like,
he's, yeah.
Get the fuck out of here. Brian Moynihan. All right, let's get into Zions Bank. Zions Bank Corp lost $1 billion of their market value because the stock traded down.
Okay.
That's how much value their stock lost in response to what we now know. So I want to break this down and I want to explain it.
Okay.
Because I think if you lose $1 billion, it's probably something we should talk about.
It's a lot of money.
All right. So a single day this happened. It was Thursday last week. We were recording this on October 20th.
Mm-hmm.
They disclosed a $60 million loss worth of based on loans that had made that were unlikely to be repaid. What led to that point was a messy, tangled web of loans that Zions said were surreptitiously subordinated by the borrowers, all while collateral was effectively eliminated. So long story real short. They made a loan to them secured by property, but on the mortgage notes.
Okay.
So they didn't make a new loan on a property. They made a loan on the loan. Okay?
Right.
I know it sounds cavalier,
right.
But this happens all the time. Let's say you make me, Saied, your Saied Bank makes me, the consumer, a loan for $1 million.
Okay.
But you, Saied Bank, wants leverage on that.
Yeah.
What
100%.
do? You go get a loan for $500,000 on that. You tell the bank, look, you got 50% LTV.
To cover a little bit of my risk.
Yeah, the underlying property protects you because I made a 50% LTV. So now the property's worth $2 million. You got a loan to me for $500,000, and they got a loan to me for $1 million.
There you go.
Right? It's $1.5 million all in. Even if I don't pay you, they don't pay me. You still can get $500,000 in coverage.
Right.
Sounds beautiful.
Yeah.
That's how banks work.
Sign me up.
Except when you do this in a world where that property don't exist. That loan on the property that I had for $2 million, that's not there. Poof, gone.
They're gone.
It's gone.
Sorry.
Rajeil, just like him.
Cut to Rajeil.
Yeah.
Shout out, my guy.
So because it's not there, the underlying collateral isn't there, which means your $1 million loan on this property, which doesn't exist, is not worth anything. And I, Zions Bank, gave you $500,000 on a loan on a property which is not collateralized.
Scary hours, man.
Scary hours. They're alleging fraud. We don't know. So shares of the regional banks all tumbled that Thursday as fears mounted around the health of their lending businesses. Are all banks like this? Are similarly situated banks across the country? Do they have this fraud risk? Is this systemic? Is this unique? Is it what the headline talking heads were calling idiosyncratic risk?
Yeah.
Unique to this set of circumstances? Zions lost 13% in their share price, that $1 billion in that day. Possible broader issues with lending for regional bank sector. Well, we don't know. Knocking the whole U.S. stock market on Thursday, the Dow Jones Industrial Average finished lower by 300 points. It didn't. I mean, not only was it across the banking sector, but it brought down the entire Dow Jones.
Scary.
Zion subsidiary California Bank and Trust is suing Andrew Stupin and Gerald Marcil. Stupin and Marcil.
Can't make it up.
Let's let that roast.
Yeah.
Until now, relatively unknown managers of several funds utilizing the name Cantor Group, doing along with their association Deba Shyam or associate Deba Shyam. I don't know. There's also some local Orange County banks that are involved in this too, from what I understand. These credit facilities were to be used by the funds to purchase distressed residential and commercial mortgage loans. Let's pause there.
Okay.
You knew as Zions Bank Corp, when you provided financing to these loans that you were giving. You, Saied, Zions Bank Corp, was giving me, the Stupin Group.
Was troubled debt.
I was buying troubled debt. Loans that had either problem being repaid or there was some type of issue with.
Mm-hmm.
That just carries inherently more risk in and of itself right there.
Well, why would you do it?
Well, probably because you're getting paid a lot of interest rate.
Probably.
Yeah. But whatever the case may be, according to them, these guys lied to them about the mortgages that were there and there weren't any liens. They're actually going a step further, saying that there were mortgages in place and they were appropriate, but they foreclosed them out and wiped out the mortgages in some circumstances.
Okay.
Or manipulated title reports to show there was.
This
a
is
lien
really just a
when there
balance
wasn't.
sheet thing. Don't look too deep into it. It's just we moved it over here. It's just,
Yeah.
Yeah.
Well, it's a problem. So Zion said they had an underwritten agreement guaranteeing them first priority interest, meaning the bank's claim on the collateral was superior to other creditors' claims in the event of default. However, the deeds that were supposed to secure the loans were ultimately subordinated without CB&T's knowledge, Zion said in the lawsuit. Those underlying properties were transferred to other entities or were in foreclosure, meaning the collateral was irretrievably lost, Zion's claimed. This is the way that Zion's found out about their. The way that they found out about their situation was that another bank, Western Alliance, already started a lawsuit for this. So that's why Western Alliance and Zion roped into the same conversation. But if two big banks, I would call them super community regionals, probably, they wound up in the situation. The question then remains: how many other banks across the country have this type of risk?
That's the scary part, right? And I mean, they're giving bankers a bad name. We've said this. We've said on the show here, right? Like. The reason why you would go to a regional bank is that concierge service, right? You build a true relationship where you actually matter to them, and as you continue to grow, it helps the bank, and you should be serving a mutual benefit, right? Yeah. But hearing something like this, if I was somebody who was starting out a business, this would freak me out, right?
Yeah, I think it's probably justified,
right? So it's like, How could somebody, vet this out or I guess be careful? I don't even know if you could.
I don't know that you can. This type of credit risk is in the system. You could look at banks' balance sheets, but we're not all banking experts.
That's what I mean.
I wouldn't expect people to do that.
Small business owner is not going to look at a bank's balance sheet.
Here's what I'll say is that they issued an 8K in response to this. And for those of you who don't know, it's a significant material event affecting the stock price. And again, those who are technical, I'm watering it down because I want to be vague here. Mm-hmm. You file an 8K to tell the general public something about the institution. They're saying that they're taking a $50 million loss now. Mm-hmm. $10 million is possibly going to be recouped of this $60 million loan, right? So they did that. They were honest and forthcoming. They actually today, October 20th, they released their earnings today, and they were actually pretty strong.
Their stock price rebounded a little bit.
They're strong. Their earnings are pretty strong.
Yeah.
So you saw a lot of that idiosyncratic risk conversation peak up. So I don't know that this is systemic, a big issue per se.
Okay.
But I do think there are lots of underlying risks like that out there, and which one of them becomes the issue, I don't know. But I can bring up another possible scenario with which we could see one.
Yeah, please do.
Okay, well, Endgame Macro via X was the previous. I want to make sure we cited that. And it was regional bank stock prices are sliding. I went into the Zion's Bank Corp thing because I thought it was important. But then I was like, okay, wait a minute. What other sector could we hit? Well, more Americans are falling behind on their auto loan payments. Here's why, according to CBS News. That's just an open, right-in-your-face answer, right?
Right.
Have you seen the numbers in this?
Yes, I have because I read the show notes. But yeah, go ahead.
Had you heard it before? I'd heard the headline before. Have you?
No, not this high.
Really?
Yeah.
I've been hearing this on CNBC, other places they've been talking about it, and I don't know why. I don't know why this has taken a back seat to the Zion stuff. Maybe because the Zion had one transaction that was big.
Right. On this show, we had suspected it for a long time, especially the subprime auto loan stuff, right?
Yeah, I think so.
Let's let you get into the article and then we can dive into it a little bit.
Perspective here is if Zion's Bank Corp is taking this type of scrutiny for one loan, $50 million, that's nothing compared to the sector damage that could be here.
No, nothing.
Right? A recent study by VantageScore found that auto loan delinquency rates have increased by more than 50% over the past 15 years. The upward trend continues even as delinquency rates in other loan categories, including credit card loans, personal loans, home equity loans, have declined, according to the report. Back in 2010, auto loans were the least risky of all products at that point in time, Ricard, chief economist at VantageScore, said in a recent video. Now, as we look at 2025, it's actually, excluding student loans, the riskiest credit product in the market.
Excluding student loans.
Student loans are a weird space right now.
It's so weird.
People fucking banked on forbearance, and I beg them to understand that was not constitutional and not going to be universally applied.
Yeah.
And I know that people are saying, well, my friend got student loan forbearance. I don't know anybody who got it, okay?
I don't know a single person.
So it just strikes me as weird.
Now, the scary part about this, right, is typically speaking, when things start to go south for people in their finances,
Yeah.
auto loans is one of the last things that goes, right? Because you need your car to get to work.
Presumptively, you have a car because you need one.
Yeah, exactly.
If you're not in a major metropolitan area where you have good, reliable transport.
I would think that if you're delinquent on your auto loan, you're delinquent on your credit card payments, right?
Maybe. In the next couple paragraphs, we'll explain. I think the luxury vehicle market became a big problem.
Oh, the luxury vehicle market.
Yeah, I think people, and I'll use the student loan example.
Mm-hmm.
People said, I don't have to pay my student loan, so I'm going to buy a nicer car.
Yeah. Oh, yeah.
Right? Like I've got $1,000 a month in student loans gone. So now I can buy a $600 a month car versus what I would probably buy, $400 a month car.
Yeah, but I think that's not even reasonable anymore. I think the average price for a brand new car is, people are probably out saying, I'm going to go buy a brand new car when they should have probably been buying a used car, right?
I don't believe in new cars, although I bought a lot of, I can't say that anymore.
Yeah.
I bought a lot of new cars.
When I was younger, I bought nothing but used cars. But lately it's been nothing but new. But I plan on holding my cars for a long time.
I hold mine for a while too. At least starting with the Jeep anyway.
Mm-hmm.
Well, let's get into a little more details here. One of the main factors hurting car owners is rapidly increasing monthly payments. Data from the Federal Reserve shows that average monthly payments increased roughly $130 from January 2020 to January 2023 to $600. Average.
Because interest rates rose?
Interest rates rose and the cost of cars went up.
Mm-hmm.
Pausing here. Corollary to the housing market.
Yeah.
This is something you should think about and you go, wait a minute. All of this stuff is exactly the same for the housing market.
And honestly, I remember, because I bought a car during that time. Remember, the wife got into a really bad car accident.
Oh, yeah, that's right.
And it was scary hours back then. But I remember it felt intentional. I know that there was a whole supply chain issue. But
was it really though?
Honestly, I think that they saw that they had a brief window in time where they could capitalize on the low inventory. And they started seeing people were buying cars in transit. I was one of them.
Let's be real.
I bought a car that I hadn't even sat in, right? Because granted, I knew the car. I had friends that owned the car.
No, I get it. I hear you.
Right?
This show has made me, because of the finance knowledge that we have because we've done the show, not something that we possessed before we got here, just we do this every single week.
No, I definitely learned way more just to stay up to date.
Which is fine. And that was an anticipated, what I did not expect was I am way, way, way more or less likely to believe like the headline. And now the conspiracy is in my head now.
Is it really?
Oh, yeah. Because I look at these companies and I think to myself, okay, you're a major manufacturer of auto parts, right? Or you're a major manufacturer of cars.
Yeah.
You guys have 3 months of products sitting on your shelves to supply. You're not running month to month. And yet these guys are jacking prices the next month going, hey, guys, our prices are going to go up.
Yeah.
Did they really?
Yeah, I know. There was some price gouging there for sure.
And I look at the companies. Okay, all these companies went through the pandemic. All these companies went through the stimulus. All these companies were like, oh, man, we're going to struggle. They all jacked their prices up. And another good example of this is I still see places to this day where I'm paying higher prices to cover, quote, insurance for workers at servers and restaurants. And don't get me wrong. I want the insurance for servers and workers at restaurants. Why am I paying a separate COVID-related charge for that still? Raise your prices, my guy.
Yeah.
Don't add an extra tax to my stuff.
I know, and I hate to be this guy too, but when I start seeing stuff like that, I'm like, okay, well, I'm sorry. I'm not coming back.
Yeah.
No offense.
And tipping culture, again, I've said this for years on the show, but it is wildly out of control.
Yeah, and I don't know. Good for you. You still do it. Honestly, I can't. When I had my whole barber situation, when they were raising prices on me, I'm like, okay, raise the price. You're just not getting a tip anymore. Like, there's nothing I can do about that. Stop. Don't make me the bad guy. Don't make me the bad. You raise your price. Now I can't.
Remember when it was like 8, 10, and 12%? I rarely see one that's not 15, 18, 20 now.
Bro, I don't see it. I don't see anything below 15. Honestly. I think I see 18, 20, 22 even.
Yeah, I see that a lot from time to time.
I'm like, what?
That one and 15, 18, 20 are probably
and then I look like the jerk looking for, where's the other? Or what? But where is it?
And I'm quickly getting to the point where I want to go back to cash so I can intentionally not leave you. I want you to see me not leaving you a tip.
No, you don't.
Yeah, I do.
But that's not the waiter or waitress's fault.
No. At a place where I get service, that's not what I'm talking about. I'm talking about places that don't give me service and still want me to tip.
No. That's your fault. Hold on, that's your fault. I had this discussion with my wife. Listen. You're not expected to tip if I'm just.
Why are y'all asking me for a tip then?
Yeah,
that's the point.
That's the point. I know that's ridiculous.
And
it's ridiculous.
Since I'm here, fuck you, Postmates. Okay, Postmates for some reason.
I'm not on Postmates. I'm a
looks
DoorDash.
like it's $20.
I'm a DoorDash guy.
Same rules apply. Looks like it's $20.
Yeah.
And somehow when you go to check out, they don't give you pricing, and then you hit checkout. I get the alert from my credit card, and it winds up being like $45. I'm like, what the hell happened?
What happened? Yeah, I didn't sign up for this.
Delivery fee, taxes, tip. You're paying as much for the meal, if not more in some cases, for delivery than you are for that. I'm like, what am I doing?
Yeah.
I'm paying $45 for burritos now?
Yes, you're supporting another family, and this is people's second, third jobs.
And look, man, I had a conversation with somebody you and I both know really well who told me that he tried this at one point in time.
Yeah,
and he made like $12 in a night.
And then that's.
So now I'm like, I can't be the guy who doesn't tip the guy who makes $12 in a night because that's a good dude.
How you gonna sleep at night?
I don't sleep very much, Saied. But at the same time, I'm like, fuck you, tips.
Yeah.
So I'm very conflicted about this. So there are people that I absolutely will tip.
Job your Postmates, yeah.
Don't Postmates your job?
Don't Postmates.
It's never going to go away.
Never. It has to stay forever.
All right. So payments have continued to escalate. 1 in 5 new car loans have monthly payments that exceed $1,000, 20% of car loans. According to auto researcher Edmunds, behind the ballooning payments are rising car prices and interest rates. The average cost of a new vehicle is now more than $50,000.
I was going to say, I think a year ago it was $48,000.
Yeah.
Yeah.
It's gone up pretty high, and it's really difficult to ignore.
I mean, how am I going to buy my kid a car? I'm already stressing out about this. My kid's 9.
Yeah, I know.
That's not that far away from me.
I think about this all the time, too.
I'm not buying you a new car, dude.
I've actively been trading my son's trade account because I'm like, I need more money for this kid.
Honestly, no, you're going to get Bro, I'm sending you on Uber. Like, wherever you got to go, get yourself an Uber.
You know the part that bothers me the most is having gone through a long analysis on the endowments for these schools. They do not need your tuition.
Not anymore. Yeah, no way.
They have multi-billion-dollar endowments, and they're making more than your tuition is not doing a whole lot for them financially.
No, and really, honestly, I can't remember who I heard say this. Okay, forget about college and universities. Okay, but just think about the public education system. At some point, I don't know how soon. It's probably not going to be this generation. It might be in a generation or two from now.
Yeah.
But at some point, it's going to get to the point where they realize, okay, this person teaches this subject very well. We're gonna have them do it. We're gonna have them record it, and we're gonna send it out. This is what everyone's gonna learn.
Yeah.
Right. There's no reason why. Why wouldn't you do that now?
Why would you? First of all, why would you not use AI?
Yeah.
You're gonna have a point where you're gonna have an AI avatar.
Yeah.
And the AI avatar is gonna sit in class. And imagine this: you ask your teacher a question. There is not a question your AI avatar teacher won't know the answer to.
Oh yeah, and you know how they're gonna start selling it too. They're gonna start pushing down. The parent sources like, kids gonna get more one-on-one attention.
Yeah.
You're not going to get this 30-to-1 ratio.
But here's how this works, right? And this is the sad truth of it. They're going to say, okay, look, the AI avatar doesn't personalize the lectures for you in person, so you have to do it from home with your VR headset on.
But the only way this happens is remote work. How are people going to stay home? Back in the day, maybe this could have worked. When you had a traditional family where one person went to work, one person stayed home, right? Nowadays, we've talked about this. Like a majority of families out there have 3 jobs between 2 people.
Yeah, we know a guy from the last episode 305, that can teach you how to get multiple jobs. What a piece of shit.
Yeah, multiple 6-figure jobs at that.
Multiple 6-figure jobs. I can optimize your work.
What do you call it? Stacking them?
Yeah, job stacking.
Job stacking. Yeah, pay me to help you job stack.
Jeez,
come on.
I'll send you a postcard when you're in prison, homie.
Yeah. These guys just look for the craziest buzzwords. Yeah. They go, oh, that sounds good.
Airbnb arbitrage.
Have you heard about this new thing I'm doing? I'm job stacking.
I'm job stacking.
What's that? Oh, yeah. This is where you get 2 jobs and you stack them on top of each other.
Yeah.
Now I'm making double the income, bro.
It's called being a scumbag.
Yeah. Yeah.
There are ethical ways to do this. Like, I'm not saying don't do extra work.
Yeah.
I'm just saying do it in an ethical, responsible, disclosed way.
Yeah.
Don't lie your way through an algorithmic interview.
No, do it in 5 to 9.
Like, you seen these guys who have like the AI in the screen, and they're doing a job interview where the job interviewer is asking questions.
All the time. It's just answering for them in real time, and they're just reading it up right.
And he's like, let me see your screen. And you show them the screen, but the screen is the second screen. It's just so stupid.
I know. Are people like really getting away with that?
That's the job stacking guy for sure.
For sure. He's teaching you how to do that?
That's for sure. It just bothers me. So it wasn't just... Unfortunately, it wasn't just cars that ring the alarm for me. The housing market has been notable. It started with Lance Lambert calling U.S. home prices as measured by Zillow, the home price index fell. This is from X. Basically said U.S. home prices measured by Zillow home value index fell negative 0.2% between August 2025 and September 2025 reading. I know it sounds like home prices are going down per se across the country, but on average, it's actually just softening. So I want to be clear here, a little bit of an asterisk. Year over year, plus 0.01%. So barely up, but still up.
Yeah.
Last month was down negative 0.1%, so kind of neutral there. Since the 2022 peak, we're only up about 2.9%. For a perspective, since March of 2020 to now, we're up 45%.
So we talked about at the top of the show that there's a 99% chance at a rate cut at the end of this month.
Over 99%.
Yeah. What do you think that does to the 10-year Treasury? Is this rate cut already baked in? Could it impact it at all? Or, I mean, we've talked about on the show where don't be surprised if you even see the Treasuries rise. I know a lot of people think that it follows suit.
So you know how this week there was, in the part of last week, there was a bit of a rhetoric around how the mortgage rates had lowered out and everything's great and everything's amazing.
Oh yeah,
that was anticipating to this upcoming rate cut.
So that's that goes to show people that this is when it gets baked in.
It's already baked in. So they were baking in this great probability of a rate cut last week. All the lenders were like, okay, hey, Saied, lender, we could steal some extra market share by lowering our rates now because we know next week they're going to cut the Fed funds rate.
Oh, yeah.
So
we'll be ahead of the game.
We'll be ahead of the game. So let's just drag in business because we're smart.
Yeah.
Right? And then everybody else around you, they're smart. They cut rates.
Yeah.
But then what happens is they cut rates. Everybody's like, oh, mortgage rates are going to drop anymore. And like, no, they dropped. No, they're going to drop more. No. They dropped, guys. They dropped.
They've been dropped,
it was baked in, cooked in.
Yeah, we already did it.
The cookies are inside, right?
Yeah.
And then what happens? The 10-year rises afterward.
Oops.
Yeah.
Should have locked it in.
And mortgage rates will creep up a little bit until such time as we get close 45 days from now to the next Fed funds rate cut. So actually the next one's December, isn't it?
Yeah, I think I saw your boy Matt post this too. Who came on the
show.
Morgan. Yeah. How do you pronounce his last name?
I don't know. I just swung it.
Yeah, he said it. He said it on the show. Now's the time to lock it in now.
Yeah.
Because he said this like last week.
I like Matt a great deal.
Yeah, I like him a lot too. His fitness journey is crazy.
Yeah, man. And he's going to be a dad soon. It's a whole thing.
Oh, speaking about being a dad soon, shout out to Ted. Ted Lifts.
Oh, yeah.
He's going to be a dad too.
No shit.
Yeah.
Wow. Those guys started listening to this show when they were like
early.
Babies.
Early, man. So shout out to Ted. Him and his wife.
Are we that? Jesus.
Expecting a baby girl. You're not keeping up with the listeners, bro.
No, dude, because I'm sitting here trying to make content for us, damn it. I'm over here micro obsessing over goddamn thumbnails like I'm a YouTuber.
No, you're doing a great job.
What would Mr. Beast do? I need more money logos. Why?
The thumbnails are crushing, though.
They're not.
No, yeah, they are. The last episode.
In order to crush, you have to get more views.
The last episode. Maybe someday we go down the rabbit hole of teaching everybody about all the stuff that we learned about what goes on the back end.
There's a lot of corrupt stuff on the back end.
That was not a euphemism.
Yeah, let me tell you right now, the back end is dirty.
It's the dirty back end.
Nobody washes the back end right
Yeah, and if you don't know what you're doing, you don't know how to navigate back there.
Listen up, America. If you think you got free speech,
it gets messy.
You do not have free speech. This algorithm is cooked.
You might have just cooked us again.
No,
stop.
I didn't say any buzzwords.
You can't stop it.
You want me to go there?
No buzzwords.
I will cuss at you with somebody's name.
No.
Ban this episode.
It took us a long time.
Yeah, it took us a long time. So I have been going down the rabbit hole in the algorithm, and it's been really fascinating because think about this. Podcasts on traditional audio streaming platforms, you don't really advertise a market for it. Those are entirely word of mouth.
Yeah.
So you go on somebody else's podcast, that's word of mouth. They like you, the audience likes you, resonate with you.
So
they go listen and subscribe.
So if you like us, the best thing you could do for us is not just like and comment on the videos, but honestly, it's referring it to a friend or a family member that you feel like could use the information that we're giving y'all.
Yeah, but admittedly, on YouTube, it's a tough game in 2025. It's not like it was even in 2023 and 2022.
Yeah.
For some reason, in this year, it is just a really, really difficult game.
Honestly, you know what it feels like? It feels like playing a pickup game and playing a pickup game to 15, you spotted somebody 10 points.
But there's all sorts of technicalities, weird things that people don't talk about, don't even know about. And it's crazy when you talk to really experienced YouTubers. A lot of them don't even know this stuff. Their channel is just so large at this point that the algorithm favors them anyway.
True.
And there's lots of things we can break down from a YouTube perspective. If anybody wants to hear that, send us a DM. I've got some really interesting business use case experience from just me playing with the algorithm and some conversations that you and I have had. Plus, I've been talking to Jake and Logan Paul's boy Caleb about our show and everything else, and learned a little bit there as well. It's fascinating.
And we got some more stuffs in the work too. Stuffs.
Assuming it all goes through. So we know that home prices are softening, but softening, you say? How much? Where? What?
It's a lot, bro.
It's a lot. We're not going to hit all of these because there's a lot of names on this list. But if you want to take us down,
let's just say Sunbelt states are feeling it a little bit.
Yeah, take me down the
list,
list,
Let's go,
baby.
Austin, Texas.
Ooh, top of the list.
That was a really hot spot for a long time. They're down 23.4%.
Ouch.
Yeah.
You think they're the guys who listen to Dave Ramsey and go, shit. He said home price is supposed to go up every year for the next 5 years.
Yeah. He sounded like my dad.
Yeah.
Like, I trusted him. He acts like he's my dad.
I mean, he's a bald, old, rich dude. He's got to know.
He's got to know.
Nope.
Okay, this one, for whatever reason, will always, like, affect me.
Really?
I don't know. I really love this city.
I love San Francisco, too.
I love San Francisco. Yeah. Down 10.9%.
I try not to go there now.
It's too dangerous, bro.
Forget
it. I mean, it's always been a little sketch, but now it's like, stabbings, like, in broad daylight is wild.
Yeah.
Yeah.
I last time I was there, I saw somebody peeing and playing a video game at the same time on the street on a television set they put on top of a car and broke into the car and hardwired the television set to the car and was peeing while he was playing it on top of the car in the street.
Honestly,
this is like in Union.
That's some Grand Theft Auto type stuff.
Yeah,
right
no,
there.
I drove by like, well, this is gonna be a short trip.
Where'd you get that idea from, though? Honestly. All right, we got Phoenix, Arizona, down 10.3%. San Antonio, down 8.5%. Denver, Colorado, 7.2%. Sacramento, down 7.3%. Tampa, 7.2%. Now, here's the thing. We're going down and we're listing all these cities, right? And you said the all-in figure year over year was up 0.01%?
0.01%, negligible.
So what does that mean? As we're listing all these big markets, right? These big metropolitan areas that are going down, but that also means in other parts of the country, it's flipping on the other side. So,
and I attribute that to the most obvious answer.
Okay, tell me.
People exiting big, expensive cities to go to smaller cities where they can afford a home.
100%.
And a lot of people exited large cities to go to Austin, but then Austin got too expensive, so they went to other places.
This is a really good conversation. I had a conversation with somebody at work about this. Will remain nameless, and we'll talk later in the show. You'll probably figure it out as we're talking. But we're like, man, our parents living here when they did and seeing what the real estate market was doing, right? They should have known better. You're setting us up for failure. Granted, we got lucky. We're in a home now. But what is that going to do to my kids? My kids are not going to be able to afford to stay here.
You don't really mean that, do you? Your parents can't have the foresight to know that this is going to happen to their. Keep in mind what your parents lived through, right? So you got. So you give an age here. I'm just going to go 1970s, 1980s, 1990s. All three of them had recessions.
No, this is what I mean. They should have noticed it, and I mean, I should have noticed it too.
What 2001?
No, the
recession?
fact that okay, at some point in time, it got to a point where both of them had to start working.
Yeah,
right?
well, I get that.
Just to be able to.
That's nationwide, though.
No. Not necessarily,
bro.
No,
you don't have job stacking like that guy. I mean, come on, you don't have like this nonsense going on because it's just isolated to major metropolitan areas where it's expensive. It's happening all across the country.
Yeah, but
half my rentals are in Oklahoma.
So then now am I doing my kids a disservice by staying?
No.
I mean, they're not going to be able to stay. So either you're going to rent.
That's not true. You don't know that.
Oh, really? Tell me why.
You don't know that. Because look, man, right now it does feel like the weight of the world is against people. It's the hardest ever in history to buy a home.
Mm-hmm.
And we're going to go through some other metrics too, which make it sound even more compelling.
Mm-hmm.
I get that. But
the wealth reset's going to help me out?
No. Everybody else going poor is going to help you now. I'm going to try to say this in eloquent ways that all right, so let me take an approach here. I'm going to try to say this without offending people because there is an underlying element here which may be offensive.
Mm.
Blue collar versus white collar.
Yep.
Right? White collar wasn't the hardworking. It was the wealthy sons and daughters of wealthy people who came into affluence and didn't have to work.
Yeah, work corporate jobs.
And sweat. And the reason why they wore blue collars, they didn't see the stains as much as the white collars did because you weren't sweating in your clothes.
There you go.
Right? You weren't the working prototype. There is something to be said in corporate American history where once you... I'm just going to say some stuff that might be a little bit charged here.
No,
so
I mean,
my mom and dad are not going to be able to leave me any assets.
Mm.
I will not get an advance start from my mom and dad. I've been paying for my mom's mortgage for a number of years. I bought her the house. I certainly helped my dad, and I am grateful and elated that I'm in a position to be able to do so. Sometimes I get a little salty about it, but it's just.
I'm sure because I mean, we've seen the trust fund babies come through our shops, and they've been handed a lot.
But we shouldn't stigmatize that because that's where this is going.
No, I mean, if
the fact of the matter is you, because of your parents' decision and because of your decisions, which gave you a home, you will have the ability to pass down assets to your children.
Yeah.
That you never had passed down to you.
True. No, absolutely right.
Right. Now, I'm not saying they should wait and hope for you to die, but your parents will also have the ability, because they bought those homes when they did, to pass down assets, most likely not to you, but to your children.
Yeah, absolutely.
And we talked about this on the Great Wealth Transfer, how it was a bit of a farce. I think it was episode 303. But that's where the Great Wealth Transfer isn't going to you and me.
No.
It's going to our kids.
Right.
Which may help to ease some of the generational gap pain as the world, particularly the United States, reevaluates the financial position of the world.
I mean, hopefully. And look, I think there's something to be said here.
It will, to be clear, disproportionately benefit some people versus others. There's no way around it.
No, it will. And it's all going to depend on, look, for some people, they're going to feel they're going to be luckier because a lot of people are starting their families later in life too now. Because a lot of people tend to not start a family until they own their first home. And now, people who used to buy their first home used to be the age of 30. Now we're looking at age 36, 37. Right.
A new report just came out. I think it was older than that.
Even older than that. Look, so
I think it was like 30 something.
So like people are, and we never know. Life expectancy might go higher too, and I hope so.
100% it is.
But
you're seeing
but there's something to be said, and unfortunately, this is something that can't be measured, right? But you also don't know, and I'm curious to get your take on this. How much of where you're at right now, as far as like financial security, is because you didn't have that knowing that I'm going to get past something down.
100% of it.
So there's also that.
I grew up, and to this day, still fear being poor. Every single thing I do is fear of poverty again. Because I grew up hyper. So it's weird. My dad acquired wealth later on and then lost it all with bad decision making. And I love my dad to death, but no one taught him how to manage.
He meant well. Yeah,
he meant well. And people all think that they have money, but the problem is the money that you have has challenges that we're not all equipped. And this show, I hope, neutralizes that for some people. But most people who acquire money and wealth, if they haven't done it over time and it's not progressive load, will lose that money.
Yeah,
because they don't understand what it takes to keep it. Getting there is only one part. Keeping it and building it is a completely different animal. And if you're not equipped for that different animal, you can always get it, but you'll lose it again. Get it, but you'll lose it again. And if you're caught in the lose it again cycle when you're old enough to not get it again, then you wind up like most people in America, where you can talk about all the amazing times that you had, but you wind up like Johnny Depp in Blow at the end of the movie.
Right. Yeah.
And it's not a good situation. So I grew up hyper poor in certain moments of my life. My mom grew up hyper poor. I don't care about the luxury stuff. I really don't. I was telling you before the show started that I'm at this position in life now where I have so much clothes and so much stuff.
Yeah.
I want to narrow it down to like a minimalist wardrobe, minimalist stuff, and be very, very simple, just because it's one less decision to make in the day.
Yeah, man. I know decision fatigue is real, and it's real for me. I'm feeling it as I'm getting older. I'm seeing like in some of the decisions that I'm having to make in real time are things that I didn't have to make before as the kids get older. Dad, can you help me with this homework assignment? I have to actively decide right now, like, yeah, I gotta cut out this time to help you with his homework assignment.
Yeah, it's wild.
And like that's not a decision that I have to make because that's not just a quick decision where I can make the decision and move on. It's no. I got to be present, right? I got to have the right attitude about it. I got to think about all the things that I want to be as a parent and do it. And that's draining sometimes, when middle of the day, you have other things you need to be focusing on.
100%, man. And I don't think you can take that away. And yet most of America will be so caught up in the rat race that they don't take the time out to think. It's easy to ignore these things because you're not faced with them right away.
Mm-hmm.
It's a conversation that I've had with my brother a number of times over the years that he keeps getting frustrated that I keep bringing up. When you're a dad, you'll know. And the sad part is he sees me, his brother, telling him that. Here's the reality. I am your father. And I don't mean that in a condescending, arrogant way. My dad's 73.
Yeah.
Okay? When my dad, 73, I'm 45. So he had me when he was, 28?
Mm-hmm.
Right? That's right. Yeah, 60, 73, 28. So, again, my brother is about 28 and I'm about 45.
There you go.
Right? So I'm closer in age and function and cognitive ability that my dad was to me than I am to you.
And especially when you factor in life experiences.
But when you try to tell people that, they see the older, wiser person as having wisdom, but they don't realize that, God, the business of being financially savvy has an inflection point. It's parabolic.
What do you mean?
It goes up and it goes down. And there's a point where we all get to where at some point at the top of the bell curve, we know enough to know about how much we don't know. And you know enough to know that the decisions that you make that you thought you could handle when you were younger really do take something out of you.
Mm-hmm.
And then you know that you have to start being more mindful of your time, who you spend your time with, what you spend your time doing, how you spend your time doing it. And you also know that each one of those fleeting moments of memories with your kids are meaningful in a way that you cannot measure because you don't know which one of those moments is going to imprint on them.
Oh, I know. That's the scary part.
Right?
That's the part that scares me the most. And I think I was listening to an old interview of Peter Attia. I can't remember it was either on Huberman or Rogan. And he was talking about this. I mean, I'm human at the end of the day. As much as I know we joke about on the show that I try to portray this like great dad image. Like, dude, I get frustrated a lot at home too.
Me too.
Right? It's like I think it's and some of that I feel like it's good for the kids to see. It's not going to all be like rainbows and lollipops and
they don't need a robot for a father.
Right? Like, okay, you're gonna see some real life expression too.
Yeah.
But what I've tried to adopt now, and I try to remind myself every time I'm in this moment, it's really difficult. Imagine that you're 80 years old and you can come back to this moment right now and relive this one moment right now.
I
right?
just want to replay.
Yeah, right. And I'm like, okay, like when I do that, it's like, okay, I can be a little bit more present.
I do something similar, but I do it in a bit of a different twist. Is I keep closing my eyes and thinking back to when I was a kid and the moments that imprinted on me.
Yeah.
Right. And it's not like these big. I mean, there are some big moments that are there that are the ones you would think of.
Mm-hmm.
But there's some moments. I lost a toy that I had outside of a mosque with my father when I was young, and my grandfather was there before he passed away at the age of 63. And my dad and my grandfather, before cell phones and everybody had lights in their pockets, spent an hour looking through rocks for this small little toy. I remember it so vividly.
Mm-hmm.
The compassion, the joking that they were making. They weren't angry.
Yeah.
They were just like, making fun of each other and having a good time.
Like light. Yeah, it's light.
Making light of it.
Yeah,
and they found it and we moved on with our night.
You remember that. Yeah.
And I remember it. But nobody lost their cool and everybody had a good time. And it's such an innocuous moment. Neither one of them remembered it before one passed, and my dad to this day doesn't remember, has no idea what I'm talking about.
Right, but it left an impact on you.
It imprinted.
Yeah.
And those are the moments that if you're not there to do that.
Yeah, man.
You can't make that happen. And it's not going to be the moments that you think of. You are most likely not going to remember them as a dad.
110%. You're 100% right. I know. And for me too, one day maybe I'll get to the point where I'll share some stuff that I've been dealing with on the show in the past. I'm not there yet, right? But I've been dealing with some stuff with my parents.
Yeah,
and
me too, dude.
And they're going through their stuff. So over the last 2 years or so, and a lot of times I'll catch myself. And it resonates more. It hits more when I'm with my son, just because it's my son versus my daughter. But when I see my son, I see me looking at me, right?
I do. Your son
And
looks
I'm
like
not-
you.
I'm
My son
trying-
looks like me.
And
I
I'm
get
trying
it.
not to get emotional, but it's
No, I
like
get it.
because you go through those times, you're like, oh, so like he's seeing what I saw back then. I got to remember that that's me. I'm imprinting on me right now.
Mm-hmm.
You know, and my daughter, for whatever reason, is different. I love them both, obviously the same, but it's very easy for me to like snap into dad mode and just love her, show her the unconditional love, show her how much I love her mom, how I treat her mom.
I think for dads, and I don't have a daughter, but I've got 3 younger sisters, 2 of which were definitely more like daughters to me, and the third one is just more of a pain in the ass. I think for dads, when it comes to daughters, it's you see your wife in your daughter a little bit.
Oh, a lot.
Whereas you see your son in you a little bit. You see yourself in your son a little bit.
Yeah, I definitely see that. And for whatever reason, like it's not that I don't try to. I'm not putting like gender roles out there or anything like
it's
that.
just your natural biologics. I mean, it's just what it is.
Exactly. And when I see my daughter, there's a wide range of things that I want to make sure that I teach her. I want to teach her all the same stuff I teach my son too, right? But what I really want to make sure that I highlight is how I love her mom, my wife, right? Because this is how a man should treat you, and this is what you should expect.
Yeah.
You know, how you should expect a man to treat you, and how I love her. I never want her. I raise my voice at my son in front of her all the time, and then I will intentionally not raise my voice on her, and I say I'll tell her why, because I don't want another man to ever raise their voice at you.
Boy, I know your wife yells at her.
But you know what I say? You know what I say? And then in the same breath, I go, "Hey, mom's right around the corner, though, and I'm about to go tell mom.
You about to go get that?
Mom about to lay the smack down, girl."
Yeah. I was a girl too. I know exactly what you're thinking. I'm not gonna go there. All right, so I want to talk a little bit about gold before we end this show. Not to have a hard turn here, but if I go a little longer, Saied and I are going to start hugging across the table, and it's going to be awkward for everybody. Gold prices are really what the conversation was that set me down this path this weekend with somebody else, and I said to them anecdotally, and I'll tell you exactly what I said to them. I was talking to my wife. We had 3 days in a row where we had a babysitter. It was really weird.
I mean, you won't go from none to 3. It's crazy. What are you doing?
We literally did not know what to do with ourselves.
Yeah.
So we were walking through South Coast Plaza, and we were having a conversation where we were looking at really expensive, stupid stuff. And I said, look, gold prices going up means something.
Mm-hmm.
Now, what that means, good, bad, or ugly, is up for interpretation. But to me, I have typically seen gold prices go up in and around recessionary economies. Not all of them, but for a long time, people always found gold to be a natural and logical hedge against inflation.
Mm-hmm.
Now, we know the only true hedge against inflation is to keep investing into whatever it is that you're investing to, dollar cost averaging, if you will, because inflation goes up, inflation in theory comes down. But over time, these things all tend to balance themselves out.
Mm-hmm.
But I wanted to go down the path because gold is hitting still at an all-time high, over $4,500 an ounce, right?
Oh, I think it's 4,300.
It's pretty high.
Yeah, it's teetering.
So this is from Reuters. Gold climbs on rate cut bets, broader uncertainty. Investors eye U.S.-China trade talks. Gold prices rose by over 2% on Monday, buoyed by expectations of further U.S. interest rate cuts and sustained safe haven demand. Safe haven demand. Ironic. And maybe it is. Maybe it's not. Maybe it's Bitcoin these days. And I don't mean that sarcastically. I mean that Bitcoin has seemed to be a similar hedge against inflation. Now, who's right or who's wrong here? Time will tell. As investors awaited upcoming U.S.-China trade talks and inflation data out of the U.S. this week, spot gold was up 2.3% at, to Said's point, $4,346.39 per ounce as of 1:47 p.m. Eastern Time in the U.S. Gold futures for December delivery settled at 3.5% higher at $4,359.40 per ounce. Political and economic concerns are driving prices higher on Friday's sharp sell-off, said CPM Group Managing Partner Jeffrey Christian. Finally, a normal last name. Thank the Lord, baby Jesus. Our expectation is that the price is going to rise higher over the next several weeks and several months, and we wouldn't be surprised at a $4,500 an ounce soon, he added. That's where I got the number from, so I wasn't crazy. The U.S. government shutdown stretched to its 20th day on Monday. It wasn't far. 20th day.
20th day.
I said 30. You said 10.
No, what?
Yeah, as you said, it was like
No,
10
you
days.
said 8 weeks, bro. What are you
I
talking
did say 8 weeks. I did say 8 weeks.
Don't wait.
Math is not my strongest skill set. I don't know, man.
Yeah.
I look at the TV some days. I swear to God, I have like deja vu. The day
No,
before.
you just
It feels like Groundhog's
you're just
Day.
seeing the expectations of how long it could go.
I think it'll go over 35 days. That's my expectation, and we're about 2 weeks away from that. So maybe we rehash this on episode 306, 308. The shutdown has also delayed key economic data releases, like we know and talked about at the top of the show, leaving investors and policy makers in data vacuums ahead of the Federal Reserve's policy meeting this week. Now, I have comments that I added here in the show notes because I want to make sure I hit these. So I actually did type these out.
Okay.
Gold typically performs well during recessions. I firmly believe that. There are some recessionary economies where it did not perform as well, but certainly in my mind, it performs better during those times for all the reasons we've already talked about. Often increasing in value as safe haven as assets during times of economic uncertainty. I would say right now we are very uncertain about.
So what do you think? Okay, so what are people doing? So are they actively selling off some of their securities, like a percentage, and going into putting that into gold instead? Because typically speaking, I mean, what would you say is considered a reasonable amount for someone to put away towards like gold and silver?
Well, I would think that you would diversify your portfolio like you would anything else. If you want to go down this precious metals in general are a conversation and rhetoric this week. You're going to see that all over the news because the U.S. doesn't really have a whole lot of precious metal stuff. This is not to be confused with precious metals in this capacity.
Okay.
Gold is more of a currency conversation in my mind than it is a precious metal conversation. Gold prices have been known to sell off just before a recession begins, but they typically find solid support during recessions itself, and many rally as the economy shifts start to recover. And this is because they typically look at this as a fungible, real, tangible asset that they can hold.
Mm-hmm.
It's the same reason that real estate investors love property.
Yes.
And what you typically see with people in the property community, real estate community, is they never have any stock.
Mm.
They're like, I'm all in on this. And why? They love leverage. So they keep a low liquidity position and they buy real estate every time they get enough liquidity to do so.
Because they want their money making more money.
They want their money making more money. Gold investors typically are not quite like that, but there are people who love gold. They're into, hey, you love gold.
I love gold.
That are like that all year round, all the time. That is not the people driving the price up in my mind. The people driving the price up are the stock market investors.
I was going to say, I was thinking like foreign countries even that are no longer, maybe they're pulling out of U.S. treasuries and dumping into gold.
There's a great website, and I have no idea who runs this, so I should be cautious before I say this because I don't know what the political affiliation or what the zeitgeist is about this, but what happened in 1971 when we went off the gold standard and some of the things that have happened. There, we could do an entire show on just what happened in 1971 when the U.S. went off the gold standard and what's transpired from then to now that has meaningfully shifted.
Yeah, that was under Nixon. That was under Nixon.
That's right.
Yeah.
I am not a crook.
Yeah.
That guy.
Yeah.
See? I know what I'm doing.
Exactly.
I'm actually surprised at you for a little bit. I noticed I have started to read more and more like Christopher Walken the older I get.
And I haven't called it out?
You haven't called it out.
I can appreciate Christopher Walken.
And I don't do it intentionally, by the way.
No, you do.
No, I don't. Like, I'll be reading and I'll go, so. The U.S. government shut down.
Bro, he's a gem.
It's a gem. Reasons for gold's positive performance: safe haven asset. Obviously, during economic downturns, market uncertainty, people flock to stuff that they think that might be able to help them against the devalue of currency. This is gold. Federal Reserve policy. When this starts to happen, Federal Reserve lowers market rates. People are like, okay, let's seek alternative investment. Oh, I know, gold.
Okay.
Right?
Yeah.
Investor confidence. Gold's history of being stable helps them here. It's kind of rode along with the S&P 500s. In some case, it's outperformed it. Mm-hmm. If you're looking at the S&P 500 and you're saying, okay, well, the top 10 of these stocks are carrying the market, and the next 490 suck ass.
Yeah.
That's a technical term, by the way. SA.
SA.
Actually, I should probably S-ass.
Yeah.
Because I don't want to be confused with
you can't do that.
You know what?
Just it's okay. Yeah. Leave it alone.
I'll figure out a better one.
Leave it alone.
It's sass.
Yeah.
You go, okay, well, I'm going to put my money in something that's going to rise along with the S&P 500 or close to it historically. Well, that's gold. Mm-hmm. Then obviously portfolio diversification is another one, right? If you're looking at the stock market right now and you're like, it's feeling a little frothy. I'm feeling like a little, tactile. I don't know, the market could go down. I'm going to go to something else. I don't want to go into real estate. I'm going to go into gold. It's an easy logical jump.
Another safe bet, maybe.
But to me, the guy who does this podcast with you, I think this signals bubble.
Oh.
This signals seasoned stock market investors in foreign countries going, okay, the market's a little frothy here. Let's take some risk off the table and diversify into something else.
There you go.
We know the real estate market's a little hyper frothy. Mm-hmm. What do you go into? You go into gold. Because you're like, you know what? At least, no matter what happens, I got a brick of that shit in my locker.
Yeah. Well, a lot of times, people can buy it and own it and not have the brick.
Yeah. You'll buy it in the stock market.
Yeah.
So Historical performance, to your point. Outperformance. Historically, gold has outperformed the S&P 500 in most recessions. So if you're in the stock market and you know that and you're buying it right now, you're saying to yourself, I wonder if I'm in a recession.
Yeah.
Because if I buy now and I drive this price up, it typically outperforms.
And the S&P 500 is not doing too bad right now.
Yeah. So it goes to tell you that something from an investor mindset, and I don't know who, I don't know where, but I know the price is going up. I know there's a lot of people.
Yep.
It's driving that change. With some analysts showing an average rally of about 28% in the 6 months before and after a recession.
Oh, wow.
Yeah. Let that sink in. I'm going to repeat that in a moment. Outperforming the S&P by 37% on average. So if you know.
So because right now we had let's see, the last quarter we had negative GDP growth, right? And then you would think that now this is that portion, that 6 month portion prior to the recession, that it could be going up. And then if we have another quarter of negative GDP growth, what does that signal? Under the old definition, that we're technically in a recession.
Yeah. Certain members of certain government agencies are playing FAFO.
Yeah. Yeah. Right.
Yeah.
Mess around and find out.
That's MAMO.
Yeah. But you know,
MAFO. Whatever. Yeah, they are. And I would tell you that having like the tariff conversation with China right now, if you were really worried about GDP, you'd be like, nah, I'll have that next quarter. Let's gap it out by 3 months. Yeah, I'm not saying anything political. I'm just saying.
No.
I'm just saying, like, you know, there doesn't seem to be any concern about that happening.
No, there isn't. Not right now. There isn't.
But then again, I guess the question is, who's going to put the data out anyway?
That one guy.
I mean, that one essential employee at the Bureau of Labor Statistics. There have been exceptions to this rise in gold, however, such as in 1981 and 1990, due to the unique circumstances like the Fed aggressively raising interest rates in 1981, or the global macroeconomic conditions causing the central banks to be net sellers of gold in 1990. Now, banks don't hold, in my mind, the same amount of gold. I have to go back and fact check that. I didn't do it for the show. I apologize. So I don't see either one of those scenarios playing out. We just went through the interest rate increases. We're now in a cutting cycle, and I don't see the banks selling off gold, at least. I think them selling off economic losses on other assets, sure, but not gold. So I don't know what this happens. Value varies by phase. Gold prices have been known to sell off just before recessions begin. And again, with that 6 months, right? So here's what typically happens. And this is objectively, I'm being general here, okay? So nobody go, wait, there's this one event in history. You're wrong. If you're that guy, my email is Saied at higherstandardpodcast.com.
SAIED.
Yeah, SAIED. Yeah. Typically speaking, leading up and into a recession, people buy gold. They start selling off into the recession and before we get out of the recession. And because the sell-off, prices will eventually, again, parabolic curve goes up and starts coming down. You start coming down as the recession starts to peak up a little bit because people are arbitraging and bridging assets. So right now, if we were entering a recession and gold price spiking up, would be indicative of me that we are heading into a recession. And you know, based on the data that I said before, and again, I said I was going to repeat it, here's that repetition. With some analysts showing an average rally of 28% in the 6 months before and after a recession, outperforming the S&P 500 by 37% on average.
Wow.
If you are somebody who makes money managing portfolios, whether you're a hedge fund or you're a wealth advisor, institutional money manager, you're going to look at that and you're going to think to yourself, if I can make my client an extra 37% in the next year or two by buying gold now, I'm going to buy some gold.
Yeah, 100%.
If you have any inkling that we're on a recessionary economy, I think I've beaten the hell out of this horse, but you get my point.
Yeah.
Now, I want to spend we're a little bit long in the tooth, but I want to spend a little bit of time going over movies. I think movies are consumer discretionary spending.
Yeah.
Okay.
Yeah. I just listened to the episode of Schultz on Rogan, and they briefly spoke about this because, you know, Schultz is in the new Street Fighter movie.
Oh yeah, that's why he has that ridiculous hair.
He had the ridiculous hair, and Tyson is gonna play Balrog. I didn't know this, by the way. Okay, so when Street Fighter originally came out, it was supposed to be a fighting game position, like basically stealing Mike Tyson's likeness.
Oh no, that character was.
Yeah, no, that character was, and that character was supposed to be originally the final boss. Hence why the final boss's name was M. Bison.
Oh, okay, yeah.
And then they just switched the name.
Mike Tyson. M. Bison.
Yeah, and that guy was supposed to be, I don't know if his name was supposed to be Balrog, but yeah, Mike Balrog was supposed to be M. Bison, as in Mike Tyson.
Yeah.
But then, somebody told him to switch it around.
No, I'd heard that, and there was a whole backstory. I don't remember that. I read it at one point in time.
Yeah.
The Street Fighter thing, just because I grew up
And
playing
50's
Street Fighter 2.
50's gonna be Balrog.
Yeah, 50's Balrog. Yeah,
That's so I can't wait.
yeah. I hate to say it, that's actually a movie I want to see, and that's actually a really good transition. I don't think you did it on purpose, but
I do
the nostalgia
is what's gonna take people back to the movie theaters.
but it's not the nostalgia of. So I got to be careful of how I say this because I want to make sure that it articulates well. It's not the nostalgia of your childhood that makes you see it. It's a fear of missing out that makes you see it. And this is the psychology that drives people of certain age demographics to movies.
Maybe a little bit of both, though.
If people around you are seeing it because they had this experience in their childhood, you too want to go see it. So that first row of people that go, that first like blush, that's the nostalgia people.
Yeah.
But if they don't recapture nostalgia and then give people the fear of missing out, bro, you got to see it.
Yeah.
Then you don't see it.
Then it's done. And then on top of that too, I know that the Dude Perfect guys just came out with a movie.
Did they really? I didn't know.
Yeah, but I mean, you got to think, right? Like that's another way to get people back into the movie theaters. You think? I mean, they're essentially influencers, right?
Yeah, well, they are influencers. Not essentially, they are influencers.
Yeah. Dude, I mean, they hired some guy to be their CEO that used to work for like the NBA.
Yeah. Also hard.
Yeah, the hardest.
That's the appropriate answer.
Yeah. So, anyways, yeah, go ahead.
Disney needs one franchise to return after Tron Ares' box office failure. This according to Screen Rant. For those of you who don't know, I've got a close proximity nexus to Hollywood. I spent a lot of time around it as a kid. And in particular, my wife and I on the first date night went and saw Tron Ares. I knew the reviews were good from the consumer, but bad from the general consensus. And I knew going in, and I do this at every single movie. I check the box office before I go because I want to know how profitable the movie was and what the opening weekend was like. And that's just me being a movie nerd from back in the day. I still love film, still love movies.
Will you watch a movie opening weekend? Are you about like?
It depends.
For me, it's scary. It's great.
Yeah,
it scares
really
me
depends.
a great deal.
I generally will not do that anymore because I don't feel a need to.
Yeah.
But I will notably mark a movie and say I'm going to watch that in the theaters. Tron was one of those movies because I was too when the first one came out in 1982, but I saw that growing up, found it really, really cool. Tron Legacy that came out, I thought was a really good movie. And the fact they were pivoting to this version of it, I knew was going to be an epic failure because they were essentially abandoning and rebooting the franchise with legacy characters.
Okay.
Jeff Bridges wasn't supposed to tell everybody he was in it, but then he leaked on accident in an interview, and he's like, "Oh, damn, man!" And then they want to tell everybody he was in it.
Yeah, but then I'm sure that drew people in to want to go see it too.
Not really, because it alienated the rest of the franchise.
Oh, really?
Unfortunately, and I understand why. There's a whole I read the whole back. I do this for every single movie I see. I go and I always read the Wikipedia about it, the production and development of the films.
Oh, wow.
So I do this for every movie I see. It's just my old school habits. But so Tron Ares failed, kickstarting a new era of Tron for Disney. The studio needs to bring back one of its most successful franchises. It wants to regain a specific audience. In August, Variety reported that Disney was searching for a new franchise that would win back Gen Z male audiences as they start to move away from Marvel. Because the Marvel franchise ran its course with Endgame. You don't have FOMO anymore if nobody else around you is seeing it. Nobody's emotionally invested.
I get it. The story continues to move on, but speaking from someone that got into Marvel late, I don't understand how you're. In my mind, you're not topping Endgame. There's nothing. There's nothing you can do.
And in their defense, the problem for them franchise wise was that is the way the comic books went.
Yeah.
So they did follow that arc, but man, did they have a cataclysmic arc.
Right.
You brought people through like a 10-year emotional journey.
Right.
You know, I mean, it was meaningful. But back to the story here. Indiana Jones failed to attract large enough audiences in animated fare like Disney's Inside Out, and Zootopia is too kid-friendly to appeal to adult male audiences, despite the box office draw, because they do make a lot of money.
They do make a lot of money. So back to that Schultz and Rogan interview. So Schultz said he had been talking to a lot of producers, and he said Los Angeles and Hollywood doesn't even crack the top 10 of places that they want to even film.
That's right.
Costs too much money.
The taxes
too much red tape.
Yeah.
The taxes are insane, right? It's like they'd rather fly to Australia to record over there.
And there's lots of states in the country that have made this very, very convenient for them. Harrison Ford gets a lot of shit for moving to a ranch with Callista Flockhart to Wyoming.
Okay.
And people are like, oh, he's not. Because in Hollywood, you're supposed to mingle with other people of your pedigree in Hollywood and stay connected, even if it's just in a, an associated relationship. It's not really like a quote friendship.
Mhm.
And everybody in Hollywood has this. They have their people that they stay connected to. They're more colleagues than they are friends. And they stay like this like fake friendship thing and they stay connected.
But it's part of the business, yeah.
It's part of the business. And Harrison Ford is like, fuck you. So for like the Grammys, I think it was the Grammys, the Emmys, I think it was Emmys. They led him to believe that he was going to win an Emmy. So him and Calista Flockhart flew out for it. When they announced the Emmy went to somebody else,
Dirty work, bro.
he dipped. Him and his wife left.
I mean,
mid-show.
rightfully so. Rightfully so. Wouldn't you?
He's like 80. You know what I mean?
Yeah, I mean, look, put some respect on his name.
Yeah, put some respect on my name.
Yeah.
But both of them are very introverted, so they leave Hollywood, they feel that way. But I look at it like, okay, yeah, he may be living in Wyoming, but most of Hollywood isn't in Hollywood anymore.
No.
So a lot of these celebrities are in Texas, for example, right?
Yeah.
I know a lot of people like Danny McBride's in North Carolina.
Mhm.
Him and his whole crew moved out there.
Yeah.
Now, granted, he hasn't done a whole lot on film as of late, but you get the point. So you got a problem in the movie theaters. Tron Ares could have been Disney's next big winner with young adult men, but it didn't draw enough interest, grossing only $60.2 million worldwide in its opening weekend. And for those of you who don't understand the movie business, that's the box office gross. You still split usually 50% with the movie theater on that, and then you got to pay everybody else in the marketing budget all the way down the chain.
Right.
So that isn't a lot of profit on a $100, $200, $300 million movie.
Oof.
And I will point out there are brands like A24, which we'll get into later on, which is Brad Pitt's production company.
Okay.
They do what I would call your lower budget indie films, and they're trying to creep up into the more expensive films. Think 80 to 100 million.
Okay.
They're typically indies below that, well below that. And they're taking bigger risks, bigger swings. And recently, one of them was a very big notable miss. We'll get into that. According to Hollywood Reporter, Ares badly under-indexed among adults aged 18 to 24. One Disney franchise that's a huge hit with young men is Pirates of the Caribbean. I almost shit myself when I read that because I couldn't believe it. But I was also happy because that means Johnny Depp's going to come back for sure.
Oh, he's coming?
This is just
That's
business.
That's it. You have to. I mean, how would you even bring that back without him? Honestly.
Here, I'll tell you how. There's 2 films in the works with Jerry Bruckheimer directing, and this is not in the show notes. One is a reboot. Right?
All right.
And the other is a Margot Robbie-led production.
Oh.
And I don't know the scripts on either one of them. I'm pretty sure they're still in development. But they're going to have to bring him back into the fold for, I'm presuming, the Margot Robbie version of it because he led the franchise.
Yeah.
The question is, will he do it? I don't know that he will.
It's a hefty price tag.
He was pretty upset about it. So Pirates of the Caribbean, but there hasn't been any entry that in that franchise since 2017. If Disney wants to win back Gen Z men after Tron 3 flopped, Pirates would be the best option. I only say this.
You would?
Huh?
You'd go back? You'd watch that?
I would only go back if Johnny Depp was in the movie.
There you go.
And it's not because there's like any weird like male, female, Amber Heard conversation. It's just because he led that franchise.
Yeah.
I was emotionally invested with him as a leader.
Mm-hmm.
And I think the same thing happened with Tron where you got rid of Sam Flynn, the son, and Olivia Wilde as the female love interest in that story. There was a whole storyline when they left in Tron Legacy that was completely abandoned. And clearly, Tron Ares was built to be a multiple part series with Jared Leto at the helm. And I would argue that Jared Leto's film career as of late has been a classic bomb after classic bomb.
Mm-hmm.
Neither here nor there. I bring all this up to say consumer discretionary spending is also flashing a warning sign. People aren't going to the movie theaters because they're looking at that saying, I'd rather watch it at home in a streaming service and save the money.
The last time we as a family went out to the movie theaters, it was over $100.
Yeah. I went with my wife to the movie theater. Just me and my wife.
Yeah.
Just popcorn and like bullshit alone at the snack bar before we got in the movie theater was like 30-something bucks. I mean, how much did we pay for the tickets? It was like 20-something a ticket.
That's what I'm saying.
It was like $75, $80 for the two of us to watch a movie.
To
watch a movie, dog.
I know.
I know people like, Chris, you got a black card. It's not for that.
That's not what it's for.
That's not what that's for.
No. I mean, think about
$80?
that. I mean, people used to do that like at least like twice a month going to the movies.
Yeah, dude. I remember when I was a kid. Damn it.
You're that guy.
I'm the old guy. I'm that guy.
You're that guy now.
I'm the guy.
You're the guy.
It was $8.
Yeah.
50 cents. You can go to matinees. Remember those?
Oh, yeah.
Do they even still do those anymore?
Yeah, they do.
Do they? Okay.
Yeah.
I wouldn't know. I don't go to see movies in the middle of the day.
We would during the summer when the 1 or 2 days a week my kids would go to my in-laws house during the summer. It was like first showing on Tuesday. It was like $2 or $3.
That's cool.
Yeah. So then and they'd play like older films.
Yeah.
Stuff that they would watch on TV. But okay, go to the movie theaters with grandma.
I bet you that imprints though.
I hope so.
Yeah.
I mean, yeah.
You never know, man.
And it's easy for grandma to keep them occupied for like 2 hours, you know?
It imprinted on me. We went to Disney World and we watched a movie that had a really weird political spin, but we watched it in Disney World with my son.
Mm.
And I was sitting next to him and just watching him watch the movie. And I'll remember that image. It's burned in my brain.
Oh, yeah.
I'll never let it go. Like the way he looked at the screen was like, oh, and we'd been at Disney World all week long.
Yeah.
It was cool. It was nice and calm. It was the day before we left.
Yeah, that's going to leave an imprint.
All right, so I have one more movie-related example of how I think that the market is pivoting, and I don't think consumers are willing to spend money they don't have.
Okay.
From Variety, why are many of the year's buzziest films failing to make a profit at the box office? Every Monday morning, Virginia-based cinema owner Mark O'Meara pores over grosses to see how the newest releases are playing in his area. Last week didn't offer much to celebrate as some well-received Oscar contenders collapsed at the box office. Asterisk here, a lot of times Oscar contenders are not your highest producing like income films.
Right, no, exactly.
They're meant to be artistic. However, I would say this class of Oscar contenders is having a real kick in the ding-ding as far as like profits go, okay? And these are big names.
Well, that's why.
Right?
I mean, you're paying these guys. How are their contracts work for these like A-list celebrities?
You're going to take a reduced profit.
But like, are they getting paid up front?
You're generally not going to get a back-end box office deal on some of this stuff. Oh, you can in some cases. What I would say is a lot of them do films like this with studios like this so they can win awards, so they can make more money or win more recognition. A classic example, this is one we're going to talk about first. A24 is The Smashing Machine. It's The Rock, Dwayne Johnson, a sports biopic starring Dwayne DJ as an MMA fighter. Mark Kerr died pretty quickly, O'Meara reports. Meanwhile, nobody did really well with Roofman, a drama featuring Channing Tatum. I
wanted to see that. I really want to see it, but it doesn't spark my interest to go to the theater.
Okay, let's unpack that. Why didn't you want to go?
Because I know I can see it at home, and I hate that.
And you didn't want to spend the money.
I didn't want to spend. No, honestly, that plays a huge part in it.
And I'd also be willing to add, I bet you nobody else around you went and saw it and told you it was great.
And also, okay, I'm fortunate enough to where I don't have to pay for a babysitter, right? But the few times that I do get my in-laws or somebody to watch my kids, I'm not going to waste it on, what is it, Roofman?
Well, let's see. And that my babysitter over this weekend.
Do you know what I'm saying?
Times, that was $150 minimum each time.
Like, it's better be worth it.
That was $500 this weekend just to be alone with my wife.
Yeah.
In a public place, dressed fully. That doesn't make any sense.
Yeah, it's not really cashing out the way I thought it was going to cash out.
Can we get bathing suits at least? I mean, damn. So DC metro area wasn't the only place where those films failed to connect. Roofman debuted at a paltry $8 million, while Smashing Machine endured a brutal 70% decline in its sophomore outing, its second weekend, bringing revenues to $18.8 million. As for other films aimed at adults, Kiss of the Spider-Woman, a $34 million budgeted musical adaptation with Jennifer Lopez, fizzled out with $850,000. That's what you get for doing Ben Affleck like that.
That's what you get. That's what you get.
Nobody does Batman like that.
I think I saw a meme where it said over the course of a certain number of years, Jennifer Lopez has more rings than LeBron.
I'm not doing this. Nope. I'm not going there.
It had to be said, people. It had to be said.
Even Paul Thomas Anderson's One Battle After Another, led by Leonardo DiCaprio, the man, the myth, the legend himself, struggled to break out despite being held as a generational masterpiece. They were literally calling this the most amazing film of Leonardo DiCaprio's career. And I'm like, huh? The most amazing film of Leonardo DiCaprio's career that nobody saw?
Yeah.
That's weird.
That's a little weird.
I didn't even know he's in it.
I mean, they're really trying to pimp it out.
I mean, they were pimping hard.
They're like, it's Leo.
You need this, Saied.
Yeah, you need this.
And everyone's like, nah. So let me paraphrase here.
Yeah, if there is one A-list celebrity that could probably try to get me to come out and see a movie, it would be Leo.
You ever seen the movie Don't Look Up that's streamed on Netflix?
No.
With Leonardo DiCaprio and damn it, Jay.
Jay
Was big, got skinny.
Was big, got skinny.
Jonah Hill.
Okay.
Woo! That could have been bad. Save the day. All right.
I'm saying
The description was not wrong, technically speaking. It was not wrong.
Right.
Now, let me paraphrase. We're getting along the tooth of the show here. Regional banks are under pressure. Real estate is quietly contracting. Gold is flashing fear. Hollywood has a very broke negative. Consumer discretionary spending, if you read between the lines. And the Fed is playing defense with the rate cut coming up. What else could there be?
What could there be, Chris?
Okay, these are not separate stories. I know they sound like that. That's the whole point of this show. They are symptoms of some disease, the illusion of stability being ignored when the cracks are coming up around you. And there's still stuff in the CRE office space that is concerning, right? Mm-hmm. Office has never recovered post-pandemic. We've already spoken about private equity, episode 304, titled The Brutal Honest Truth About an AI Bubble, How Private Equity Will Destroy the Market. Thank you very much for that working title, Chris. You're welcome, Saied.
You crushed that.
There's obviously the private credit market and shadow banking, which we can talk about on a future episode. There's an entire, like we talked about on the top of this show, there's an entire market of people making private loans in private credit issuance that underwrite however the hell they want to, which has got a massive bubble and a problem there as well.
Yeah, how do you get comfortable with that? I mean, what are they taking as collateral?
Well, I'm glad you asked.
Mm-hmm.
It is the fastest growing market in the past 5 years. It's now showing its first sign of cracks. We can get into that in a future show. Some private credit funds are marking loans down quietly, especially those tied to CRE and leverage buyouts. Think about this. If a bank would not finance it, they went to private credit groups,
which is charging a wild interest rate.
And you did that taking on risk. Well, that risk is coming due. It's ringing the bell. Yeah, it's a problem. The refinancing wall in 2026 through 2027 is looming. And many loans will need new capital that's now twice as expensive, which is what we talked about at the top of the show with refinancing. Mm-hmm. And if you need new capital, it's twice as expensive. Expect there to be financial implications to the system. Not maybe, not speculative. There will be.
It's happening.
That's going to happen. And from my personal experience, the first wave was 2025 was moderate. Mm-hmm. It was more than double the 2025 volume in 2026 and almost triple that in 2027. So there's a lot going on that's out there. There's a ton that we can unpack in future shows. But suffice it to say, there are weakness signs in the economy, weaknesses all around us that we choose just to take as mere tidbits of information, but we don't put them all together. That was the aim of the show.
Mm-hmm. And what can people do to best prepare?
Well, don't go see bad movies.
That's good for your psyche.
All right, the best thing you can do best prepare. Prepare now by being smart financially. Try to lower your expenses to the extent that you can. If you have any superfluous spending that you do not need to do, discretionary spending, I would say pull back and start using that money to go into investments. If gold happens to be one of your preferred vehicles, there's plenty of ways to do that. Mm-hmm. I think you continue to dollar cost average through your traditional investments, low cost index funds we talked about, stock that you may believe in. But no, any stock you buy right now is probably at an all-time high. I bought Apple years and years and years ago. Mm-hmm. I've stayed through multiple splits now. I think 2 splits at this point in time. They're at an all-time high today. Would I buy more Apple today? No. Do I believe the stock? 100%. It's just really expensive today.
Yep.
iPhone 17 was kind of a win for them. But you buy companies that you believe in today for the value you'll see tomorrow if you're going to buy companies individually. If you're going to go into index funds, go into a low-cost index fund like VOO, VIOO. There's a number of them from Vanguard. Fidelity has their own
look at those expense
low-cost index 500 fund. And you ride it through. Are you going to see some impacts to yourself and your 401k in the coming months and year? Probably.
Yeah.
And what I tell most people, and I had somebody call me over the weekend and ask me this question, and they said, Chris, I'm worried about the stock market. I'm worried about my 401k. What am I going to do? And my first question was, how old are you?
Yeah, valid question.
She says, I'm 50. I said, okay, great. How much longer do you think you're going to work? Oh, at least till I'm 65. I said, you got 15 years. She goes, yeah.
Yeah.
I go, then I think you should ride this out and you should not look at it and you should continue to invest the same cadence and volume. Cashing out now may be good near term, but maybe painful long term. What are you going to cash out and do with it?
Yeah.
I'm going to hold cash. I don't think that's a good idea.
No.
So I think you ride this out. And I know it says, hey, inaction is not. No, I'm not saying that inaction is not smart. I said, if you're worried about your 401k, I'm telling you I'm worried about your daily spending habits now. That's what you focus on.
Yeah, that's what you focus on right now. And I still think that there's still a little bit more upside to go between now and whatever happens.
Oh, for sure. Yeah.
You know? I mean, the rate cuts are definitely going to help that. They're going to help the growth stocks.
Near term.
Yeah, near term. So, yeah. So, I mean, and hopefully that only, like, narrows down, you know, it coming down.
Yeah.
So.
Rajeil, take us out.
Take us out, bro. Cut to Rajeil. All right, we miss you, bro. Can't wait to have you back on the next one. All right, you got anything else?
No, I think I've talked way too much tonight.
No, you crushed it, bro. The Liquid Death really got you going.
Liquid Death.
Yeah.
The big 20 ounce.
Yeah, the 20 ounce.
Hoss, the booty killer can.
Made my cans look small.
Yeah, petite cans.
I appreciate you. Make sure you subscribe, hit that like button, ring that notification bell, send this out to all your friends and family. We love you guys. Thank you for doing this. Thank you for hanging with us this long.
So much.
Good night, everybody.
Okay, bye.